because you cannot make IPOs great again and increase the number of public companies unless Nasdaq becomes great again too. Have you ever wondered what's really happening inside the microcap markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Microcap Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman. Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most committed and ambitious entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or just operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a clear, real-time view of what's happening in the microcap markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings, to reverse mergers, SPACs, and secondary offerings across all aspects of the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
I'm Caroline, and welcome to Inside the Microcap Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the microcap ecosystem and break them down in a live question and answer format for Joe to give you his take from the trenches. Before we get into today's questions, Joe, just tell us from a high level a little bit more about what you're seeing there on the front lines of the emerging growth ecosystem.
Yeah, thank you, Caroline. So right now, I'd say that the microcap industry is still trying to figure itself out. Things are definitely moving along a little bit better, though. So as you remember, in the first quarter of last year, there were only 5 microcap IPOs. I'm happy to report that from our Lucosky Brookman data desk, that already now through the last week of May, there are already 7 more microcap IPOs. So it seems like the system is opening up a little bit, and perhaps the exchanges are getting a little bit more comfortable with the new rules and how to interpret them. And frankly, we're just seeing a lot more excitement and flexibility in the market. So I remain very optimistic that things are going to sort themselves out, and the second, maybe third quarter is going to pick up a lot more.
I know everybody wants to hear more market updates and real-world analysis from current deals. With that said, today we're going to talk about the controversy surrounding Nasdaq's proposed 5 million market cap delisting rule, why it has created so much backlash in the small public company world, and why you were just on Capitol Hill meeting with a bipartisan group of senators and Senate Banking Committee staff about it.
Yeah, that's great. That's a great topic. I'm very, very happy to talk about that. It was a very exciting 2 weeks, especially being down on Capitol Hill. And I'll tell you that the comment period ended on Friday, May 22nd with the SEC, and the rebuttal period is now open, and I believe ends on Friday, June 5th or somewhere around there. So this is a really timely issue, but it's also timely and important, I think, because there seems to be a growing disconnect between what's going on in Washington and really what's going on with the exchanges in New York. And a lot of people inside and outside of our ecosystem are starting to take notice.
Before we jump in, can you tell us a little bit more about that?
Yeah, I mean, look, on the one hand, the administration and the commission, including the SEC, are talking about getting more companies public, making IPOs great again. All of these positive developments. I mean, Chairman Atkins and others have said publicly over and over and over, even as recently as last week when they proposed some sweeping changes to how emerging growth companies raise money. They've been very, very vocal about these goals. On the other hand, though, Nasdaq is really pushing this proposal and other rules that do the exact opposite. Really for a meaningful part of the small cap and emerging growth markets. So it's really not just a rule debate. It's a much bigger question about where the policy direction and market structure is going between the 2 main regulators of our industry.
And that is exactly why we wanted to do this episode, based on the questions we've received and what is going on right now in the market. So now we're going to get into some of the questions we have for today. And just to level set here, everybody, These are real questions coming out of the market right now from companies, boards, investment bankers, and even live deals. So if you've got a question, please send them to us at questions@luckbro.com. That's questions at LUCBRO.com. And maybe we will cover it on a future episode. So let's start with this. A lot of people hear 5 million market cap rule and may not realize how aggressive this actually is. So what exactly is Nasdaq proposing?
Well, what Nasdaq is proposing is actually pretty simple, and that's what makes it really dangerous in my view. So, right now, if a company trades below $5 million market cap for 30 consecutive trading days, Nasdaq wants the ability to suspend and immediately delist that company, full stop. That's the proposal on the table right now.
And what do you mean by full stop?
Well, I mean, once you hit 30 straight days below a $5 million market cap, you are automatically delisted. I mean, there's no cure period, there is no compliance period, there's no hearing panel. You literally go from a deficiency notice to a delisting cliff immediately.
So this is not fix it and come back. This is fall below the line and you're gone.
Yeah, that's basically right. And that's why the reaction to this proposal has been so strong because the proposal strips out a lot of the flexibility that historically existed in the listing framework and the appeals process.
Okay, but Nasdaq would obviously say that they're trying to improve market quality and protect investors. So what's wrong with that argument?
Well, the problem isn't the stated goal. I mean, everybody wants strong markets and to protect investors. The problem is that this rule uses a very blunt, volatile metric, which is market value, and then attaches immediate and severe consequences to it. So, for smaller companies, especially those with market values that can bounce around or move around a lot, this metric has nothing to do with whether the company belongs on the exchange, deserves to be on the exchange, or is viable to continue on the exchange. It is just an automatic delisting blunt metric that is also arbitrary, by the way.
But come on, Joe, are we really supposed to believe a company trading under 5 million market cap belongs on Nasdaq?
That's a fair point, Caroline. And a lot of people have asked that question, including, me. But the answer is not every one of them will belong on NASDAQ forever. And that's really not the issue. The issue is whether you have a rigid, automatic, price driven rule with no cure period and no process around it. All we're saying is these companies should get the benefit of an independent hearing. And those companies that should no longer belong on the exchange, well, they can get delisted by the panel. And the companies that still have a future or the panel believes should remain on NASDAQ, well, then they can stay. But you can't separate these two groups if it's just an automatic, rigid cutoff.
And can you just expand on that a bit more? Because that's really the heart of it, I think.
Well, because the markets don't wait for a technical breach, meaning the rule itself becomes the catalyst for the decline way above the $5 million market cap. And I don't think people are thinking about this fully or really appreciate how this works. Once the company starts trading below a certain amount, and we can debate what that amount is, investors start pulling away right away because they don't want to be caught in this downward spiral that could happen. Sometimes liquidity dries up, prices go lower, and it really becomes a problem for companies to start raising money or raise additional money when they're in this downward spiral. So the damage isn't confined to $5 million or $4.9 million or $5.1 million. The damage really starts much higher market cap.
And you just said much higher up. What do you mean by that exactly?
Well, I mean, it's not really a $5 million problem. And that's what I think most people don't understand. Look, right now, there's about 179 NASDAQ companies below $5 million, according to our Lucosky Brookman data desk. And there's probably somewhere around 315 or 320 companies, somewhere between 5 million and 20 million. And then another 250 or so between 20 million and 50 million. So you're roughly talking between 700 and 750 companies on NASDAQ that have an under $50 million market cap. This is a real part of the emerging growth ecosystem and a real part of the listings on the senior exchanges. This isn't some tiny outlier group that we're talking about. And once investors and bankers and really any market participant start viewing the lower end of the market as a delisting danger zone, the practical floor for real capital is going to move much higher than the $5 million.
Okay, but can you explain that so a real market person can understand it? Why does that floor move up?
Well, because nobody waits for an actual breach. If I'm a serious investor, I'm not waiting around to see if a company slips under the line for 6 straight weeks. I'm going to be start selling or getting ready to sell way, way earlier. So the rule creates this structural downward pressure before the company even technically trips the violation.
Okay, but there is another thing that people in this part of the market talk about all the time, and it is controversial, so I want to push you on it. Are you also saying that this kind of rule could make short selling pressure even worse?
Yeah, there it is. I knew you were going to bring this up. And it is a real concern. And a lot of people don't like to talk about it. And we shouldn't be afraid to talk about it. In the microcap world, when a company starts breaking through the lower end of, I guess, market cap levels, 50 million, 40 million, 20 million and below, a lot of people say the short pressure can get very ferocious, meaning there's a constant barrage of short sellers on your stock. And one of the fears that people have in this market is that this rule really creates a rigid, automatic delisting environment. And you're really creating a much cleaner path or clearer path for these aggressive trading strategies and these short sellers that really push the company toward that $5 million arbitrary rigid line. And it's especially important nowadays in this algorithmic trading environment.
Okay, but let's be precise here because this is where people either nod their heads or roll their eyes. So, what exactly are you saying?
Well, first of all, before I say anything, I just want you to know I'm nodding my head and rolling my eyes. I'm just kidding. I think this is a real concern in the market, and it's real concern, for market makers and other trading participants that can basically sell stock that they own or don't own in the ordinary course. And when companies keep getting pushed lower and lower, especially towards that delisting territory that we talked about, retail investors really end up holding the bag as the stock keeps getting crushed and crushed because most retail investors aren't selling short or short selling company stocks. That's more of an institutional concept and a market maker concept. And if a company gets kicked off Nasdaq and sent down to the OTC, then the economics of that trade get even uglier for the company and its shareholders. And the only people that win, Caroline, are the institutions who have enough money, enough time, and enough patience to continually short a stock.
So, you're not saying that every company under pressure is the victim of some grand scheme. You're saying this rule could make an already ugly dynamic even worse.
Exactly. I'm not saying that every stock is subject to a short sell campaign or getting tons of selling pressure inappropriately. All I'm saying is that in world of the microcap markets, where sometimes stocks are a bit more fragile, and the market knows there's going to be this automatic cutoff or cliff at the end of 6 weeks, it's not unreasonable to believe that these large institutions and market makers can basically sit on a sell order and wait it out until the real damage is done. By implementing a hearing panel strategy, one, it's fairer to the companies, fairer to the markets, and also keeps these short sellers guessing so they don't have a very clean, clear runway to cash in on their short selling investment.
So, the retail investor angle here is what? That the people this is supposedly protecting may actually be the ones left holding the bag?
That's exactly one of the concerns. So if a stock gets driven down, right, and loses its exchange listing, it's going to automatically lose liquidity and lose market attention at the same time. And then it gets pushed to a much weaker trading environment where retail investors are often the ones holding, the bag or experiencing the wreckage. And moving these names, by the way, to the OTC doesn't really solve the problem. In a lot of cases, it just transfers the problem to a different platform and arguably makes it worse. So again, this is why I say the rule may sound like it's some great investor protection in theory, but in practice, it really is going to end up doing the opposite in most cases.
So, who actually gets hurt by all of this? Can you give me the real world version, not just the headlines?
Well, the first thing that comes to mind is companies, innovation, retail shareholders, the very people that NASDAQ and the SEC are supposed to protect, or at least their stated mission is to protect the retail investor. Certainly not the institutions, certainly not the market makers or the short sellers, but the real everyday people. It's also going to hurt innovation, American innovation in all types of industries, from biotech to pharma, med device, AI, clean energy, whatever industry you want to talk about. It is going to have a catastrophic effect on innovation, capital raising, and for these companies that often are capital starved and need to be public, in order to grow their companies, it's going to have a real effect on them being able to carry out their growth strategy and their life mission. And here's the thing. If you build a rule that says in 6 weeks, if a stock is trading below a certain amount, you're going to automatically get delisted, that's going to attract bad actors. It always will. And given the problem already in the markets with these short sellers, I don't see how this rule will do any good for anybody.
So your point is this is not just a microcap problem, it's an innovation finance problem and a staying public problem.
Yeah, I mean, look, it's both. And this is how you make it much harder for smaller companies to innovate, to grow, to raise capital, to get public, to remain on a national exchange. Again, this all goes back to the disconnect, I believe, between Washington and New York at this very moment.
Okay, but Nasdaq would say that this is a response to manipulation, IPO abuse, bad actors, all the stuff that the market has been complaining about for years. Isn't that fair?
Yeah, listen, that concern is fair. The problem is the solution is not fair, and that's the difference. If the problem is manipulation of tiny IPOs or bad actors, then they should address that problem directly. And to be fair, NASDAQ has been addressing those issues over the last few years, especially in 2025, when they passed a whole number of rules around the IPO and foreign issuers and discretionary reviews and all of that stuff. But this proposal is the wrong solution to a real problem. Here's another point that I think is important. If we're going to talk about fraud or manipulated stocks or rampant dumps or whatever the news organizations are calling them now, this really doesn't stop the original harm. It really just creates, in my mind, a mechanical trap that can catch legitimate companies in the crosshairs because it doesn't do anything but compound the problem on the back end. So stopping fraud and stopping these promotions is a very worthy goal. We all agree there. But this rule doesn't help that.
So in your view, this is just an overcorrection.
Yes, I think it's an overcorrection, but it's really more than that. It's a misdirected correction. It's not just that it's harsh, it's really pointed at the wrong place too.
I want to talk about Washington because that's what makes this more than just another industry complaint. You were just on Capitol Hill a few weeks ago. Who did you meet with there and why does that matter?
Well, I want to say that I had a great time down in Washington. It was really nice to be invited down there by some of the groups who are spearheading this issue. And I went down there in connection with the Small Public Company Coalition and was joined by a few others, including Dave Donahoe, who works regularly with NASDAQ companies just like we do in the space. And we met with a group of really bipartisan senators and bipartisan group of House members, including some representatives from the Senate Banking Committee. And it was really, really nice to speak to them and really turned out, I think, to be a good day of learning and listening and advocating for the emerging growth space. And the reason that this matters, in my mind, is simple because this isn't really just an industry gripe. It's really becoming a big policy issue for politicians on both sides of the aisle, and people are starting to take notice.
Okay, but what was the reaction? Were they just being polite, or did you actually get the sense that this is becoming a real issue in Washington?
Look, I came away believing that this is becoming a real issue and that we had a good session and good reception from basically everybody we met with. Now, I'm not going to overstate it. I will say there was real engagement, there was real concern and real interest from both sides of the aisle in helping to understand the impact of this rule on smaller companies, on innovation, in jobs, in capital formation, retail protection. I mean, the list goes on. And more importantly, I really felt that it is a bipartisan concern and both sides of the aisle really listen with good intentions. So this isn't a left-right issue. This is really in my view, a public market issue.
And that's where the contradiction comes in, right? Because you said earlier that Washington is talking about making IPOs great again. And on the other hand, NASDAQ is moving toward a rule that could force smaller public companies out.
Yes, that's exactly the contradiction. And I've written about this both publicly and on LinkedIn. And of course, internally, I talk about this a lot of time. It's a very, very serious, I think, disconnect where, again, Chairman Atkins and people at the highest level of the commission are putting forward or forward facing an agenda that really is meant to help more companies get public, help more companies stay public, help companies be able to raise capital easier and more efficiently and more cost effectively at a time when there is an all-time low of public companies. Now, you can't do that while allowing the main listing exchange for emerging growth companies to adopt rules that specifically fly in the face of those stated goals. Those two things do not fit together.
But let me push you on that because this is where it gets uncomfortable. NASDAQ is saying, in effect, we're being pushed to clean up our markets, while the SEC is saying, in effect, we want more companies public than ever before. So which side is outstating it here?
That's exactly the question, because both sides have publicly said versions of those things that you mentioned. And at some point, they just stop adding up. If NASDAQ is saying that it has to do this, and they've said this publicly, they are getting regulatory pressure from the SEC. They've said that. While Washington and the SEC are publicly saying, well, we want more companies to be in the system. We want more companies to stay in the system. There is clearly a disconnect. And that is why this has become more than just a NASDAQ rule filing, in my view. It's now become a broader market structure and policy alignment issue among the two biggest regulators in the emerging growth space.
So bottom line, is this a NASDAQ problem, an SEC problem, or a policy alignment problem?
Well, I think it's all of the above. I mean, NASDAQ seems to be acting as if its job is to sort of cleanse the market of these smaller companies. And Washington, at least publicly, is saying that they want more public companies, easier access to capital, et cetera. At least that's what I gathered from being on the Hill last week. But there also seems to be this group of insiders inside the SEC that seem to be very misaligned with the top levels of the commission, including Chairman Atkins, some of the commissioners, even the administration. So if that is the real policy direction that the commission wants to take this emerging growth world, then NASDAQ really needs to become aligned with it, because you cannot make IPOs great again and increase the number of public companies unless NASDAQ becomes great again too.
And just to be fair, you're not saying there should be no standards. That's not your point.
No, not at all. This is not an argument for no standards. This is an argument for better, fairer standards. If NASDAQ and the SEC think there needs to be a market value rule, then fine. Then give companies an independent hearing like it is now. Let them trade during the appeal. Use the hearing panel discretion. That's what they're there for. Build in some flexibility that recognizes how microcap companies actually trade in the real world, and give reprieve to those companies that absolutely deserve it. And for those companies that don't, well, then let the hearing panel kick them off. That is a much smarter framework than this terrible automatic cliff, and frankly, a much better, more practical approach.
Okay, but how would that work in practice?
Well, it's very simple. Really, nothing has to change. If you trade below $5 million for 30 consecutive days, then you go to an automatic and even expedited hearing panel. The company can make its case to these independent, panel hearing members and make their case why they deserve to stay on NASDAQ. If the companies have real things going on and it really is just a technical market issue, then maybe the company will stay and the hearing panel will give them a reprieve. But if it's something more serious, where there's bad actors or there's fraud or manipulation or just, anything else, then they can get delisted. We're not saying that you can't have this rule. What I think the industry is reacting to is how the rule is designed.
So your point is not do nothing. Your point is slow down for a few weeks and let somebody actually make a judgment call.
Exactly. What is a few weeks to figure out if a company actually can stay or deserves to be on NASDAQ versus this automatic, onerous, cliff of being delisted? And by the way, what is the exchange afraid of? Why not let an independent panel make that call over a very short and, expedited period? it seems to me that there's really no issue here. The industry and the exchanges, everybody is saying the same thing. The only thing we are debating is how this rule goes into effect and the practical reality of carrying it out. We all want better, cleaner markets. We're just arguing about how to get there.
So bottom line, Joe, what is the one thing that you want people to remember from this episode?
The takeaway is really this. I think a public market that gives, small and emerging companies no cure, no hearing, no second chance of independent voice is really closing the door on American innovation. And if the SEC is serious about getting more companies public and keeping more companies public, then Nasdaq rules need to reflect that reality. And this proposal, as written, does the exact opposite.
You've been listening to Inside the Microcap Markets with Joseph Lucosky. For more insights from the trenches of the microcap markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@luckbro.com. That's questions@lucbro.com. Thank you for listening, and we look forward to next time.